Welcome to the weekly deep dive. If you're anything like me, you probably feel like the amount of information coming at us right now is overwhelming. Between the AI breakthroughs, the stock market swings, crypto, and the general economy, I found myself reading endless newsletters and listening to podcasts, but just barely retaining any of it. I was essentially consuming information without how it connects and totally missing the bigger picture. So I decided to fix that, and this podcast is my solution. Every Saturday or thereabout, I sit down to synthesize the chaos of the week into one clear narrative. My goal here is really simple, it's to practice articulating complex ideas, to ground myself in what's actually happening, and to help you connect the dots without having to read the entire internet. This is really just a quick passion project of mine. It's not about the views and it's not about the hype. It's just about understanding. So let's get into this week's synthesis. Right now, the United States is quietly betting its entire economic future on artificial intelligence to save the country from a crippling national debt crisis. But at the exact same time, the US government is banning its own top AI models over a security glitch that was actually flagged by Amazon. It is a staggering contradiction. We have the government relying on AI to save us while simultaneously handcuffing our most powerful AI labs based on a tip from the lab's own primary investor. When you look at how those conflicting forces are sending shockwaves through global bond markets, physical commodity prices, and even the hardware that powers our hospitals, you start to see that the old maps we used to navigate the economy are completely obsolete. That contradiction is exactly where we are starting today. Our forces today cover a wildly eclectic mix, pulling from various AI industry newsletters, strategy notes, and some crypto analysis. So, we're going to try and connect this seemingly unrelated dots to understand what a US naval blockade in the Middle East actually has to do with Silicon Valley AI bans. Before we really get into this, I need to make something clear in that my sources sort of contain highly politically charged events, specifically the Trump administration's actions regarding the Iran's peace deal and their executive orders banning Anthropic's frontier AI models. We aren't taking any political sides here, and our only goal is to impartially report the facts and unpack the mechanical impact of these moves we've seen in the global market. That impartial lens is critical because the bond market doesn't care who you voted for, it only cares about yield and risk. Let us start with the texture of what is actually happening on the ground. We usually think of AI as this purely digital, weightless thing living in a server somewhere, but the AI company Midjourney is completely shattering that assumption. They are not just making digital pixels anymore, they have built a physical hardware full body scanner. The specs describe a system that lowers users through an ultrasound ring to create an instantaneous high fidelity topographic map of the human body. What really stops me in my tracks is that they are rolling these out in a spa environment, bypassing the grueling FDA approval process cycles required for clinical medieval devices. The frontier labs have realized that digital data is finite, but the physical world is infinite. It is a glaring signal that AI is bleeding out of our laptops and becoming a tangible layer of physical infrastructure. That actually segues perfectly into the Anthropic situation, because while AI companies are trying to push into the physical world, the government is desperately trying to shove them back into a heavily regulated box. Anthropic recently had to pull its most powerful models completely offline worldwide, driven by a US export control directive citing a jailbreak vulnerability. But the irony here is rich, because the vulnerability was flagged by Amazon to cover their own cloud hosting liability, and the government's response was to just pull the plug entirely. Over 100 cybersecurity executives argue this ban spectacularly backfires because it blinds the defenders. By banning the model outright, the US government is essentially confiscating the microscope from its own white hat researchers, while attackers just pivot to rival models like OpenAI's Daybreak or China's Moonshot, that gap between how people think AI works and how it actually functions in the wild brings us to McDonald's of all things. They are piloting a Google-powered AI drive-thru in 5 locations, while highlights are critical concepts called bot sitting. Bot sitting is the hidden human labor required to clean up, fact-check, and wrangle AI outputs in real time. Put a frontier model in a noisy drive-thru lane, and suddenly the AI hallucinates an order for 14 sides of tartar sauce. A human employee has to manually override the system, and the promised productivity gain vanishes entirely. While all this incredibly tangible friction is happening, the financial markets are basically playing fantasy football with reality. Look at decentralized prediction platforms like Polymarket, where people are placing million-dollar betting pools on the exact day an AI model gets unbanned. When you can instantly turn every global event into an executive room into a highly liquid betting market, the line between investing in a casino completely dissolves. That casino mentality is the perfect bridge to a massive structural thesis called the Big Shift. It is a collision of the commodity supercycle and the AI disinflation master plan. We are leaving an era entirely dominated by software and zero-interest paper assets, and swinging violently towards hard assets like physical commodities and digital infrastructure. Federal Reserve Chair Kevin Walsh has a master plan that relies heavily on AI. If AI tools can make the American workforce 30 or 40% more productive, the fundamental cost of producing goods and services plummet. His plan was to keep rates manageable, let banks lend, and rely on the explosive productivity gains of AI to absorb the inflation pressure from our staggering national debt. But geopolitics threw a massive wrench into the machine when a military conflict involving Iran shut down the Strait of Hormuz. Global oil prices immediately spiked to $115 a barrel, triggering a massive wave of inflation. This was a highly sophisticated economic pressure campaign targeting the US bond market, deliberately paralyzing the Federal Reserve's AI master plan. Eventually, a US-Iran peace deal was completed, the blockade lifted, and AI plummeted back down below $80. Oil plummeted back down to $80. But the very moment the US gets the geopolitical breathing room to let AI save the economy, the government bans Anthropic's flagship model. And while we do that, China just released DeepSeek, a massive cheap open weights model that completely crashed US tech valuations. Wall Street suddenly realized that the American moat around AI isn't nearly as deep as they assumed. This shift is forcing massive strategic moves, like Microsoft's CEO Satya Nadella warning that just paying for an API key is not a real business strategy. He argues that true defense comes from building a learning loop, which means hand-wiring a company's unique human judgment and proprietary workflows directly into an AI system. It ensures your veteran know-how stays in-house and protects you from AI commoditization. Speaking of defense mechanisms, Elon Musk just executed a move that is staggering in its scale. After his wealth crossed $1 trillion, largely driven by the massive SpaceX IPO, he used that inflated stock currency to acquire an AI coding startup called Cursor for $60 billion. He essentially bought the ultimate means of digital production to accelerate his physical engineering empire, bringing the software layer entirely in-house. Meanwhile, traditional finance is stuck playing a very dangerous game of chicken. The US recently added 172,000 new jobs, but inflation is sitting at a 3-year high, which leaves the Federal Reserve completely paralyzed. While the Fed is frozen, AI labs are burning through cash at an unprecedented rate, with OpenAI burning $3.7 billion in the first quarter of 2026 alone. Other countries are radically re-engineering their entire societies to keep up with this arms race. Chinese universities have scraped more than 12,000 arts and language programs over the last 5 years, swapping them completely for tech and engineering fields to adapt to the AI jobs market. So how do you navigate a world where rockets are buying coding, AI, and inflation remains sticky? The macro strategy notes layout of a strict barbell strategy, which we've covered in depth over the last couple of weeks. The long story short is heavily weighting your investments on two extreme ends of the risk spectrum and holding nothing in the middle. On the defensive end, we have institutional whales are quietly absorbing tens of billions of dollars in Bitcoin. BlackRock has even launched a Bitcoin premium income fund, using covered calls to generate immediate cash yield, which proves the asset has matured into traditional institutional infrastructure. Capital is also rotating heavily into physical commodities like gold, silver, and oil. Central banks can print infinite amounts of fiat currencies to service their debts, but you cannot quantitatively ease a barrel of oil into existence. On the offensive side and of the barbell, it is all about digital infrastructure and sovereign hardware. We are seeing innovations like Open Reuters Fusion API and infrastructure layer that dynamically routes requests to multiple AI models simultaneously to find the cheapest and fastest result. But if you are sitting in the middle of this barbell running a traditional software as a service wrapper or doing middle tier coding, you are in the kill zone. My sources also highlight a glaring mechanical warning signal to watch: the thread between the 2-year and 10-year Treasury yield. During the recent geopolitical chaos, that spread completely collapsed from 1.5% down to just 0.4%. Institutional lenders fundamentally refuse to buy long-term US debt, which is a red flashing light that the credit markets are freezing up. Moving forward, there are two specific signals you can check to see what or which way the system is tilting. First, watch if oil actually stays below that critical $80 a barrel threshold so the Fed can execute its master plan. Second, watch the prediction markets to see if the odds of the government unbanning our top AI model suddenly crash. You have to actively hardwire your unique human judgment and physical world friction into your value proposition. We spent the last decade assuming the end state of technology was to become entirely weightless. That software would just eat the world. But looking at the massive rotation of capital into sovereign hardware, it raises a critical question. What happens when artificial intelligence realizes it doesn't just need more digital text to read, but it actually needs to consume the physical world to keep growing? The X-ray of our economy might be incredibly murky right now, but the machines mapping our physical reality are getting very, very clear. Thank you so much for joining me for exploring the real machinery beneath the headlines. I will see you next week.